Good morning. You're watching Behind the Bell. I'm Brad Smith, and we are coming to you from the Nasdaq in Times Square, New York, where ADP just rang the opening bell, and I'm currently joined by Jan Siegmund, Chief Financial Officer of ADP. Welcome, Jan.
Thank you for having me, Brad.
Absolutely, and thank you for being here for ringing the opening bell this morning with ADP.
It was a fun opening.
ADP National Employment Report was launched over 10 years ago. How has the data published in that report evolved since then?
Yeah, when we started 10 years ago, we tried to find a new mechanism to inform the American public about the US labor market. And we developed a model, and over the last 10 years, we gradually refined and improved the model, gave more detail to it, and had quite a good ride. You know, we started with full employment 10 years ago, and then the big Great Recession happened, and 6-7 years of recovery, and the National Employment Report has covered all of that throughout the 10 years.
Absolutely. Now, what's the major difference then between the U.S. Bureau of Labor Statistics and how they evaluate employment and how ADP evaluates it?
Yeah, so ADP publishes our National Employment Report on Wednesday before the Friday when the BLS publishes their employment data. And we use two different methods. ADP is a very large HR and payroll company, and we pay 24 million people in the US. 1 in 6 workers are being paid by ADP. And so we have very accurate information of who gets paid when. And so we use that payroll data, make it anonymous and aggregate it, and create basically our own estimate of what is the growth of private sector employment in the US. And then it's often compared to the BLS, which uses a little bit of a different methodology. The BLS sends out surveys to companies, and companies fill out the surveys and do it in. So sometimes we are very close to each other, and sometimes we're a little bit off, but in general, our National Employment Report is a very precise predictor of what is happening in the US labor market.
So then, thinking about some of the sectors within that labor market, what sectors would you say have seen perhaps the fastest growth, and which are we kind of still looking at?
So when you think about the US economy in the last few years, we had very steady employment growth. About 200,000 private sector jobs were created every month. And when you cut the data now, which we love to do, is you see that actually a small businesses have started to outperform a little bit. And that has to do with the US economy doing well on private house construction, for example. So smaller construction companies get into business and they hire. Credit is going well, so financial has been doing well. And of course, tech has been doing very well. So you can see this. The West Coast compared to the East Coast has done much better. And the sectors that have struggled a little bit are manufacturing and, of course, the energy sector. So with the fall of the US, of the crude oil prices, the energy sector had a really tough time, and a lot of people, unfortunately, have lost their job in that sector.
Understood. Now, for the data in the report itself, the fact that it's been around for 10 years speaks volumes to the integrity of the data that's within the report. How would you describe the impact of this report?
It's quite impactful because we know the data is being used by the financial services industry, by investors, by the governments. We have many requests from different government agencies to use the data and work with it. And I think the general public has enjoyed the information, and it has moved markets. It has moved the US currency. You can buy actually options on the outcome of the National Employment Report in Chicago. So it is really the premier indicator of employment other than the government data.
Understood. Now, what's the status of wage growth then?
Yes.
Are there certain areas that are doing well or better than others?
Yeah, so for the longest time, for 10 years really, we published only employment growth. So how many new jobs have been created and where. And last year, we started also to offer more information about wage growth, which is very interesting because as a large payroll processor and company, we have, of course, great insight about how wages are evolving. And one of the big problems in the US economy was that we had steady employment growth, but we had very limited wage growth, only 2.5% wage growth. And so now to understand the sources of what is the problem with it and where are sectors that are growing faster and which are growing slower was very interesting to discover. And so one example I have, if you are living on the West Coast, your wages are growing faster than if you are living in the Midwest or in the East. So the attractive job industries like high-tech and technology firms, the labor markets are very tight, and we have seen increases in wage growth as a consequence for it. And then on the other hand, if you're working in the energy sector and you have to move out of that energy sector and find another growth, this is very hard for workers in that sector, because the energy sector is traditionally a high wage paying sector. Sure. And when they switch out into new sectors, we see that their wages decline pretty significantly. And I think that's part of what's shaping the political debate in the US is this dichotomy of some people really doing well, but many people having trouble to participate in the growth.
Certainly, and you know, that's a topic that comes up in every election year and political debate as well. You mentioned earlier, 10 years ago, we were at full employment, and we've since gone through this kind of expansion and recovery. For millennials, though, knowing that we have a lot of the next generation perhaps watching today, what would you say about millennials in the workforce now?
Yeah, they are entering in full force, and they have, of course, different behaviors in the labor market. They don't look forward to 15 years at the same company, and are much more flexible and have stronger requirements on work-life balance and so forth. But when you look at the data, the people that experience right now the highest wage growth are if you're in the age bracket between 20 and 24, if you're in technology, and if you're on the West Coast. Then you're in luck, because wages growing on average 7% in that sector. So for those millennials that chose to be there in industries where a technology skill set is demanded, you can do quite well. But many others struggle, and of course we had growth in the hospitality industry, for example, and other industries where the wages traditionally are a little bit lower, and the wage growth is also slower in those industries. So again, this dichotomy between the haves and the have less.
Interesting. So sweet spot, West Coast, 20 to 24.
That's what I'm talking about today. Yes.
Wow. Okay. Well, that's good to know. I'll send some of my younger cousins and family members
send them
out
over there. I
sure.
think it's going to be a good time for them.
Just one more question for you before we wrap. The brand ethos here at Nasdaq is ambition, coupled with the tagline "Ignite Your Ambition."
Yes.
What advice would you give to that next generation of ambitious leaders who may strive to be in a position similar to yours one day?
I think every generation will create their own opportunities, and to have passion for what one does is always the critical element. And my thought, being in financial service, in a financial position, an accounting position, and people sometimes say, oh, maybe that is a very dry situation you're working in. But I feel one can make its best out of everything, you know, and you can show excitement and ambition for whatever you put your mind to, and that's what I would encourage everybody to do.